History does not repeat itself exactly, but it absolutely rhymes. And right now, there are so many leading economic indicators and global economic events that absolutely empower and educate us right now to be able to predict what will happen in the future as it relates to the housing market. And now I don't pretend to be an analyst or make any claims as to be an accurate market timer, because the truth is nobody can accurately do that. But as a boots on the ground operator of a high performance real estate team and a former stockbroker of 18 years, I can absolutely take what's happening right now across every market, across every economy, across all of corporate earnings season, and use that information to connect the dots as to what is very likely to happen in the housing market in the near term. If you're new to the channel, welcome aboard. My name is Chris Igo, and if you're a returning viewer, I appreciate you in participating in our journey. And I am committed to making the best content to empower you to make the best decisions for yourself, for your family, and for your financial bottom line. And while yes, I am a real estate professional, my intent is not to sell you anything, but rather it's to educate and inform so that you can determine what moves are right for you. And I recognize this is not a one-size-fits-all approach, but it would be irresponsible of me to not share what I see happening in real time and apply that to the future. Now, I hope you find this content valuable. And if you do, please subscribe, share it with a friend, give it a thumbs up. If you got any questions or concerns, leave them in the comments down below, and I will answer you as soon as I possibly can. But let's get into it right now. And what you can see being reported right now, although it is not a leading indicator, it's a lagging indicator, is that the Fed's hit job is working. Fed's intent to slow the economy by raising interest rates to combat inflation, which will unequivocally raise unemployment, is working. In August, the job market plunged by 1.1 million job openings. And to be clear, job openings, or the lack thereof, is not the same as mass layoffs. But we are absolutely seeing consolidation, and we're also starting to see many big companies reduce their costs in any way they can. And layoffs are absolutely coming. And mass layoffs are absolutely going to determine the future of the housing market. Because when the daily cost of goods, basic supplies, and I'm talking about food and gas and transportation costs, and I know I could get a lot more granular, but I'm not going to, you get the point. When the cost of living is extremely high and the consumer does not feel confident about their ability to make ends meet and feed their family, they don't feel secure in their job, well, chances are they're probably not going to make their mortgage payment if they can't. And so while the local market that I serve and support has not been negatively impacted yet, I know for certain there are many people that I work with on a day-to-day basis that live above their means. And these are affluent people and families who in many instances have a combined family income that is significant. But if you live above your means and you make $1 million and you spend $1 million too, well, then you're broke. And I know this doesn't apply to everyone, but it applies to a lot of people. And the Fed has talked about the fact that there's a lot more pain to be felt, which tells me they don't think what we're experiencing right now is even pain. And I know for certain when the pain of the recession becomes too much to bear, people panic and they scramble for the exit door and they look for liquidity. They look for cash right now. And that is the worst position that you ever want to be in if you're thinking about selling your home. And if everybody thinks the same thing at the same time, well, best of luck. But right now, many people are burying their head in the sand and they still feel wealthy, at least as far as real estate is concerned. But I receive phone calls on a day-to-day basis from people who are looking at their stock accounts, which have gotten decimated, and they're panicking. They don't feel wealthy anymore, and they certainly don't feel safe and secure. They feel vulnerable and at risk. And they are. And I'm going to share some of the markets that are most vulnerable according to Moody's Analytics. And keep in mind, analysts are wrong all the time. So I personally don't put too much faith or confidence behind their analytics. But I absolutely want to know what everyone thinks. Because if I'm empowered and I know what's going on across every space, I can make the best decisions for myself, for my family, and for my financial bottom line, irrespective of market conditions. Now, as I've mentioned previously, I used to be a stockbroker for 18 years, and this is not my first rodeo. I remember vividly when banks and institutions and economies, and Greece for crying out loud, failed. And most people thought it was impossible to happen because they'd never seen it before. But the truth is, if you go back in history and study the rise and fall of different economies, everything that's happening right now is 100% predictable. And so I'm sharing this chart of Bank of America stock just to give you some historical context. 2007, Bank of America was almost a $40 stock. And 2 years later, it was $4. And the government and Warren Buffett had to bail them out. And there are many instances of this. I'm only using this as one case study, but I vividly remember the fear and the uncertainty and the panic that investors felt in that time. But everyone was terrified, and there was a real risk on a bank run, meaning investors would pull all their cash out of the bank because they didn't trust the banks anymore. While we're not there now, we could very easily be there again. And I mentioned that history doesn't repeat itself, but it rhymes. And Credit Suisse, or Credit Suisse, depending on how you want to pronounce it, well, it seems like the second verse is the same as the first. But there is some very strong concern about the capitalization of this massive bank. And the CEO went out there to say that they have a strong capital base and liquidity position, in spite of the fact that there's been a massive increase in credit default swaps that insure investors and protect investors in the event that Credit Suisse fails. But I hope all of you remember credit default swaps and the impact that they had on our economy and how they were the black swan that devastated everything. Because the banks and institutions and lenders that provided the funding for those swaps didn't have the money and created systemic failure that the government funded and paid out. And I read your comments. And one of the questions that a lot of people ask is, what was I saying to clients when I was a stockbroker? And to be clear, nothing that I'm saying right now is intended to be financial advice. I am not a financial advisor. I'm not a CPA. I'm not a stockbroker. I'm none of those things. But I can share what happened in the past. And what I said to everyone back then is that the government should not intervene. And that if they do, they're going to be kicking the can down the road, which will be even more devastating than whatever pain would be felt then. And I was right. And we're getting very close back to ground zero. And here's what Wall Street thinks. And mind you, I take this with a massive grain of salt because Wall Street is wrong all the time. Wall Street analysts believe that the US housing market is going to see the second biggest home price decline since the Great Depression. Morgan Stanley is calling for a 7% correction. But I love how analysts like to hedge their bets and call that 7% correction the base case. But they go on to call a bull and a bear case, which is that home values could appreciate 5% and they could decline 10%. And so to remain consistent to the talking out both sides of their mouth philosophy, Goldman Sachs goes out there and says the exact same thing, saying that home prices could drop 5 to 10%, which is a revision from last month when they were calling for just under 2% appreciation. And Moody's Analytics is out there with the same forecast, 5 to 10% correction. Unless, of course, there's an economic downturn, in which case it could be 10 to 15%, and that could take somewhere between 12 to 18 months. If only there was somebody who was sharing this type of information for the last 6 months. Oh, wait, that's me. Now, I will include a link to this map in the description and comments down below so that you can check it out yourself. This map of 400 different markets within the United States represents whether they are over or undervalued and by what degree. Now, to be clear, I don't necessarily subscribe to their train of thought. I absolutely know that in my market, there's no more land to develop. So there's a scarcity of resource in land. And in spite of astronomical mortgage interest rates, which I believe are going higher, the demand for homes in my market is still robust. And so if buying a home is right for you, there are many strategies that we can use to go out there and negotiate you the best deal possible, including a seller rate buy down, which can very likely reduce your mortgage interest rate substantially. So if you're thinking about buying, you've got a lot more leverage, a lot more options, a lot more choices. Go out there and get your dream home and dream lifestyle, negotiate the best deal possible. But if you're thinking about selling, then you must be in front of these trends. Because if a bank fails, or the stock market gets cut in half, or some black swan event happens, it's way too late for you to get involved. Because at that point, everybody will be doing the same thing, and the competition for you to get what you want is going to be massive. But the market is always right, and real estate will always trade, and it's always a good market for someone. Now, I've had a lot of people reach out since Hurricane Ian which was devastating and hurt a lot of people. But their belief is that those homes and that real estate that was devastated is valueless and that no one will ever buy it. And that conclusion is dead wrong. The truth is, big money, institutional money, will gladly gobble up all of that and max out what they consider to be the highest and best use of that land, which is why it's critical to watch what big institutional money does, because big institutional money is not running from real estate. In fact, they're coordinating their efforts to be even smarter about it and gain even more so they can max out the rent and further capitalize on the inflationary environment that we're in. Now, I know this doesn't apply to every market, but it's absolutely what's happening right here in South Florida. Now, if you're unfamiliar with the area and you want to learn about every city that exists within South Florida, please click the link below and we'll send you our free city/relocation guide, which will tell you everything that you want to know about every city in South Florida. And I also notice a lot of you are not local to my market. We are committed to serving and supporting you at the highest level, no matter where you're at. So if you're thinking about moving ever, and you'd like to be connected with someone that we know, like, and trust, a professional that can get you exactly what you want, irrespective of market conditions, then please opt in for a referral and we'll get you connected right away. And please leave any questions or comments that you have down in the comments below. And I promise I'll get back to you as soon as I can. Now, I hope you found this content valuable. And if you did, please subscribe, give it a thumbs up, share it with a friend, and check out my next few videos because I suspect you're going to love them a lot. And until next time,